morning. My name is Roy Idrach, and I'm going to be your facilitator for the Wilson County Library Seminar. Today, we're going to be dealing with lesson number 5. So, therefore, on lesson number 5, we're going to be doing options. We're going to start with a basic format of option and gradually move into more complex activities options. There are over normally 60 different type of option combinations that can be done. We're going to do certain level, but we don't want to go to all 60 of them. Most of them are very risky and very complex, and normally it's done by hedge fund managers and stuff like that to take protection from their investments and what have you. You as a single individual and be what is considered a retail customer, it's best not to even try to do that type of trade. So we're going to concentrate on what actually a new individual can do and he cannot do. Some of them it requires a signature from the broker before you are allowed to do it, and you have to show experience and knowledge in this product before a responsible broker, because not all of them are, let you do it. So with that, we're going to move into options. So I'm going to see you on the other side. Thank you, and I see you now on the classroom. Good morning. Welcome to the Wilson County Library Seminar. This is an online seminar, and we're going to be teaching today options. So as we mentioned before, the free weekly seminar is via internet and only via the library channel. If you have any questions, you can go to the library and send me an email from 28 to Floresville 2018@yahoo.com. The channel that you're going to see this lesson is on the resources, and in the resources you will open that tab, and that tab will take you directly to the lesson that you're working on. So folks, students, let's get start with options. We are going to be doing lesson 5, and with that, as you all know, we're going to do strategies, simple option strategies. I've been doing trading for over 48 years, so I will do my best to explain to you from the very basic to the most complex options, what is done and how it works. So with that, let's start with the basic options seminar. As I mentioned before, and I'm going to bring it up again, the risk of trading option, puts or call. Okay, so number 1, those who write options or that sell options, better known as covered call, they collect the money 100% upfront. Number 2, the buyer is at a disadvantage. When you buy an option, you are at disadvantage. There's a lot of things involved, including that the price is overinflated by increased volatility. So they might give you 100% volatility, 75% volatility. That also raise the price premium of the option, and therefore that overinflated volatility get the broker to get some more money, make on commission. Option values don't match the gain. One more time, I'm repeating this, the value of the underlying assets. The only underlying asset can be commodities, stocks, or ETFs. The option time value decreased to 0 at expiration date, and this is where the one that buys it is at disadvantage. Trading is just another name for buying and selling. It's just that simple. So with that, let's start with options. As you can see here, options are like a supermarket, you know. There is something for everyone. You go to a supermarket, you can buy from toothbrush to bakery to, shoes and who knows what else on it. Options are like that too. REITs is a stock certificate. We can see the Pet Milk Company and the Pepsi Cola Company. We are one of the largest collection in the United States of a stock certificate. So we're going to deal with a stock option. This is the stock is the asset and the option is a derivative. It derives from the price change on this stock. Option is nothing more than a contract. It's a contract to buy or to sell the stock. Another place where you can use option is with the ETF funds. You can also do that. Rather than buy just one stock, you can buy into a fund, exchange trade fund, that it might include something like basic material, technology, cyclical consumer products, utilities, and many things combined into one. So rather than own one stock like in here, you can own multiple stocks. It's very similar to mutual funds. However, a mutual fund have a little problem. You cannot buy options of mutual fund, or you cannot sell options of mutual funds. So the option can be used on the ETF fund because they are traded just like a stock, but it's a combination of many companies. There are options also for commodities. In between here, you notice I put commodities here. This is going to be like oil, gold, silver, cotton, stuff like that. However, this is not the purpose of this class. We don't trade coins, we don't trade currency, we don't trade commodities. So therefore, the commodity is more complex. You got to put a deposit on the future of that commodity, and a lot of things can change on that, and this is not the purpose of that. This is not the intention of this course. So therefore, you can get options on commodity. When I first started, I started doing commodities like copper, buying options on copper because it was cheaper than buying the contract. Eventually, I moved up into stocks and so on. So now you notice that when you have an ETF fund, a fund is made out of many stocks, so it's kind of fractional. So I put in here United States currency, and I say currency because currency is paper. Many people don't know, but many years ago, we have fractional currency. This is a 10 cents fractional currency. It's paper money. However, the government quit printing this stuff, making this stuff, but you can use it to pay right now. I can go and I have plenty of them. For $1, I can take 10 of them and buy something that costs $1. However, because the collection value is more valuable than $1 just to be 3 cents because the government don't make it anymore. So remember this, there are all kind of opportunities because there's something for everybody when we deal with options. So you can trade commodities, futures, ETFs, stock, and what have you. And with that, thought I'd explain you this part of it so you get a general idea of what it is. Not all options are possible for everyone. There's some more secure than others, and we're going to go over that right quick. So before we go in there, let me explain you here what happened, right? So when we're dealing with options, over here we're going to deal with the General company. This is recently priced. It closed yesterday on Thursday, February the 11th. It went up $38. But what we are concerned is not with the stock himself, with the option in regard to the stock. So let me show you how this is done. An option, it can be a call or it can be a put. Okay? So let me explain you how this works. An option is actually a contract. It's something that it comes out almost like on thin air because it's not a stock, it's not a commodity, and it's not the ETF itself. The option is a contract that derives its value from the actual stock that is right here in the middle. It could be an ETF, it could be a stock. In this case, we're going to show the ETF of Idrach Corporation. So this is the company, but the option is not that you own this yet. It's something that you can buy a contract based on a price, and we can say, okay, the option can be done as such. The action that you can take on an option that is right here on this little line where we say action is that you can buy to open a contract and you can sell it to close the contract. You also can sell a contract to open, and then to cancel that order you have to buy it back, which is buy to close. So let's get this straight. A call, you can buy to open, you can sell to close, you can sell to open, and you can buy to close. So it's vice versa from each other. So this is the action that you take. So you can also have own the stock. You can also buy this. The guy that buys the stock, he can sell to open an option to generate more money. So if he sell an option, for example, on the stock that he owns, that is called a cover call. Because he got, you see, it's a cover call. He buy a call. It's a cover call because he owns the stock. And therefore he can sell an option. And in this case, he's going to sell a call. When he sell a call, he probably expect he can protect himself in case that the price of the stock go down. The premium that you collect on the option work as a hedge, and it help you reduce any losses. So first, let's do to buy a call. When you buy a call to open, you just bought the call, and let's say that the price right now at 316, and we want to buy a call that is out of the money a little bit at 320. This is the over price. This is the strike price. This is strike price here for this particular option that's going to expire February 19. It costs $6.40. Our options are based on 100 shares. So it's going to be 6.40 times 100 and whatever the commission is. So this contract will cost you $640. However, think about this. If you were to go and buy 100 shares of the stock, it will cost you right about, I think, $31,000, right? We could say that it'd be 100 times 316, so that's going to be about $31,000. So not everybody can buy 100 shares at this price because you need $31,000. However, when you buy an option for $640 here at 320, you can enjoy profit as this price goes up without having to invest $31,000. And this is what it makes it so easy to buy options. because the ability, the enticement that you can make a lot of money with very little investment. That's actually why options are so popular. So if we are going to buy an option, just a plain option, the most you can lose is $640 is by February 19, 21, the price is no higher than $316. So if it goes up to 326, then this option going to cost more than 640, and therefore you can sell it. You're going to sell to close and make a profit plus whatever is left in the premium. Now, here's something else that you have to realize, right? The premium lose value, we had discussed that before. So as the stock goes up, you're also losing on the premium side. So it don't want to be dollar per dollar deal. Now, let's say they say, oh my goodness, I don't have $640, but guess what? You can buy to open one at 340. It's much cheaper because it's further out of the money. This is in the money, $310, because the price is already $6 into the money, as we're going to see later. Therefore, now the value is $12, so you almost have double in price, but be in the money $6, right? 640 from 360. From 640 to 1220. So you have two choices here. One way out of the money, 340. So you now only have to spend $140. It won't go up in value as fast because but as the price keep on increasing, this option will gain value. So you can do it either way. At any time where you're doing this, if you don't like the way the price is going, then you can execute this action, which should be right here. This is the window that you're going to click. Okay, my option is 340 or 320. I don't like the way it's going. You click here and you will show this. You're either going to buy to open, sell to close. So saying you already bought it, then your action will be to sell to close, and whatever the money is it $400 or $300 left, that's what you're going to get minus the commission. So when you buy a call, you expect the price to go up. When you buy a put, you expect the price to go down, and as the price go down, you make money. So when somebody tell you, well, the price went down and I lost money, you can say you should have bought a put to ensure your investment. You can also use an option as an investment to protect any losses. So you hedging, In the case that you buy a put, you don't have to own the stock either. You just buy the put or a call, and that's it. Let's look at this. You own the stock. Well, you might want to buy a put in case that the stocks go down. The put increase in value as the price go down. So if we're going from 310 to 300, notice that the price will go up just like the one that at 330 is $16. The 320 is only 19. Why? The put at 320 is much higher than 330. So notice that now that the price at 330, the price has gone down, then it worth more. So there was a time that probably the 340 it only worth $4, and as the price went down, now it worth $16. It's the opposite of what happened on a call. On a call, if the price is 310, the stock that was 300 and now it's 310, it's going to worth more, right? Because it been longer in the money. Now it's going down this way. keep on going from 300 to 310, so now it's worth more. That's what it worth, because now there was $300 here, but the stock is 316. So those that bought an option at 300, they're going to get $19, right? Because 16, those that bought it at 320, well, they can only get $6 because it's not over 320 yet. It still got some time to go. So as the price goes up, the call gain value. As the price go down, those who bought a put, they gain value and they make money on the price going down. So in the market, you can make money going up, or you can make money going down. What you need to be is on the right side of the street. If you expect the price to go up and you don't own the stock, you still can participate on the downside, just like shorting the stock by buying a put. And as the price go down, your option will get value. At that time, if you buying a put, and you own the stock, you can buy the put outright. You can sell a put to make money. If you own the stock and you expect the price to go up, you can sell a put, and as the price goes up, guess what happened? The option worth less and less. So you bought it at $9, now it can go to $4.70 as the price goes up, and it worth less and less. The order executed the same way on both sides. You execute the order here for your action. You're going to buy a put, or you're going to sell a put, or you're going to sell a cash put, And when you sell a cash put, that means that you sell to open. You don't have to own the stock. So the premium, let's say I'm going to sell a put to open at the price of $3.20, and it's going to cost right about $9.50. So you're going to receive the $950 into your account, and by the 19th, if the price keep on going up and it goes to $3.40, you're going to keep all this money. When you write an option, you keep money. If the price start coming down and this thing get more expensive, then you have to what? Buy to close. You have to buy to stop the losses now, because the prices start coming down. You have to make up the difference. So you sold an option for $950, $950, and the price come down, and all of a sudden now the price of the option for the same thing worth $16. You got to make up the difference. You got to make $7.40. So in order for you to get out of it, you have to go out and add $700 and give out your $950. That's a different strategy altogether. All those things, we're going to explain it here. So we're going to move to the first slide here about what really happened. The stock price, is $100 a share. And the price, we have seen this before also, when there's demand for buyers, demand that buyers want to buy it, too many buyers drive the price up. So it can go up from 100 to 120, right? As an example. We got a stock that we just showed that it went $38 in one day, so it must be a lot of demand and good news about this company. On the other side, right, too many sellers drive the price down, or too few sellers, right, drive the price up. So if there are no sellers, right, and there are people here who want to buy, in order for you to get them to buy, you have to offer them more money, and that means that drives the price up. Well, there's not few buyers, the price go down, because nobody want to buy the stuff, right? So if nobody wants to buy, you have to give him a lower price. You're like going to Walmart or anything you're going to buy where you can get the lowest price. It's just that simple. In this case, the same thing happened. So with that, let's get into the option now. So here we dealing with the stocks and exchange trade funds. They all fall in this category. You can buy a call, like I said, right? And either the stock or the exchange fund is $100. So you expect the price to go up, and this is what you buy in a call. And you hope they go even higher than 110, so you can make $10 a share times 100, it'd be $1,000. Now, you can buy an option. You notice that before we got different prices going up and down in here. You can buy it at the money. That means that you're going to buy a share. The strike price is going to be exactly at 100. You can buy in the money at is a little higher than, or you can buy at $99 or $95. That'd be $10 in the money. So you can buy in the money, or you can buy higher than 100, which would be like 110. So then you're buying out of the money. In order to make any fair price, the price of the stock had to be above 110. So you got three choices here. You can buy an option that strikes exactly 100. You can buy one that is lower than 100, so it be in the money already. Or you can buy it out of the money right here, which should be higher than what the price is at this moment. So anytime you buy an option, you got those three choices. You can buy at the money, in the money, which should be below, so it's already in the money more, so you can buy at 95, so it's $5 in the money, so therefore you have to pay a little bit more for the option. And then you buy out of the money, you're going to pay less, like that one that it only costs $1.40 because it's out of the money. The other one that was in the money, it cost $6.40 or near the money. So if you buy a put, you see, and instead of buying a call, that means that the price has to go down, and you can buy that put the same way. You can buy the put at $100, a strike price. The strike is 100, so you can buy it at the money, or you can buy a little bit higher than 100, which would be, let's say, 105. So the put that is 105 is in the money because the price is already below 105. So you buy in the money, or you can buy out of the money, which is going to be maybe at $90 or lower than 100, and therefore this is out of the money. It haven't reached 90 yet. It had to be lower than 90 for you to be in the money. So if you buy at 100 on a put, if you buy a 90, you'll be out of the money. If you buy in the money, it'll be 100. I mean, at the money, you'll be in 100. And in the money, you'll be already, you got to be like 105. So you buy a put at 105, it's in the money because the price is right now 100. So it's lower than 105, so the premium will cost more. So there are three options here to do. If you buy a call, you expect the price to go up. If you buy a put, you expect the price to go down. If you can either do that with ETF, or you can do that just by buying outright the stock. You could probably do that with commodity too, but this is not about commodities, and it's a different story with commodities because it's not a stock, it's a future contract and all that, and different currencies, and this is not what we're working on. So let's go and see over here the next slide. Okay. So now we got over here that a guy that owned the stock. On the previous slide, you didn't own the stock. You just bought and sold them. here, if you own the stock or the ETF, you can sell and write a covered call as a hedge or as an income generator. So now you are on the seller side, you see. You own the pet corporation or you own this technologies fund, and you say, you know what? I pay $100, but I can sell a call for 110, and when the price reach 110, I'm gonna make $10. So I'm gonna make in 100 shares $1,000 plus the premium that they pay you for that. So maybe the premium is $5, so you're gonna get an extra $500. You also can do this, right? You can also, and again, you can also sell the option in the money, at the money, or out of the money. On this case, I'm selling an option, and 110 is out of the money because what? The price is 100, and I own the stock. Of course, since I pay $100, I don't want to sell the stock at 90, right? Because I'm going to lose money. That you're already in the money, so you want to be selling it there, and you hope that the price don't get to 110, so you can keep the premium and keep the stock. You keep both, whatever they give you for the option, and you keep the stock. If the price go down, let's say that go down to 90, right? The $500 that they give you for the option price, guess what? The option price now gonna be way down of what they give you, and it help protect your price here, right? So it's gonna cover you to $95, and then from 95 to 90, you are losing now on your stock 500. Because they give you, instead of losing 1,000, you only lose 500 because somebody pay you $500 for the option for 110, but the price went down. So therefore, you are here. You can do here, the other individual can do this. He can buy the stock, right? Or you can do another strategy that comes later where you can buy one and sell the other one. But we're not there yet. That's what they put it there for. Now, here we go. Here's another step. If you buy a call, right? There's no problem. But if you sell a call, you're going to sell a call and you don't have the stock. And you're going to sell a call at 110, and you hope that the price never go over 110, so you can keep the premium, and you don't own the stock. You don't have to own the stock. No stock to buy. So when you sell a call like that, they say that you are naked. The reason that they say you are naked is because you don't own the stock, right? Therefore, if you don't no stock to buy, you are naked. On the other one, remember they call it selling a covered call. A covered call because what? You own the stock. So if I don't own the stock, I still can sell an option, but I'm naked. I'm exposing myself to a lot of risk. If something goes wrong and the price goes up, I'm going to have to go and buy the stock and sell it to the guy, right? Buy for the guy for more than the $500 that he gave me, or whatever. So the same thing happened now. You can also sell a put. You're still naked, but normally when you sell a put, sometimes the broker say, well, to sell a put, you have to have the stock, or you have to have cash to cover it. So it depends what the arrangement is. So we can mean from buying stock or buying puts and buying call, Now we selling put, but we don't own the stock. On the previous deal, we was selling calls, right? We were writing or selling a cover call, so you're not naked anymore because you own the stock. So you are protected by the stock. If something goes wrong, you already own it. On this guy here, when you sell it and you don't own the stock, you are naked. And when you're naked, that's what it means. You don't own it, and if you sell too many of those, and something will go wrong into the market, you have to make up a lot of money. So now let's see here. This is a cash put that I'm talking about. You still don't have to own the stock. You see, when you own the stock, you can sell a put. You're not naked. But over here, when you sell a put, the stockbroker might say, okay, you have to have cash for the equal amount that you sold that. In case that the price goes against you, you need to cover that. So you can sell a put, right? And what's going to happen here, before we were selling calls naked, now to sell a put, they might tell you, well, you had to have the cash to cover that put. So the put is $500, and you can be in, out, or out of the money. Same thing again. Guess what happened? They say a cash put. So you get 500, you have to have 500, right? You're gonna make 100% return at expiration date. So it's expired next week. Well, next week, the price keep on going up. You keep the money that they give you, the 500, and the other 500 were your deposit. So you're okay on that too. Now, we're going to move into something a little bit more complex. We're going to do a color option, a strategy. So we're done with some of the basic stuff. Now we get into something a little bit more complex. To do a color option, you have to own the stock, right? Or you can sell it without the stock, right? But what you wanted to do is protect your investment in case something goes wrong. So this is to hedge yourself. You want to protect your investment. So let's say that you own a stock that is $200 a share. In order to do a color setup, you have to own the stock, $200, whatever the price of the shares is. And then you say, you know what? I'm going to buy a put. Number one, we had not established the call, but it takes two steps. You have to buy a put, and then you're going to sell a call. And this is the beauty of this one. So let's say that you buy a put for $500 to protect your investment in case that the price go below 200, and you're going to sell a call to help you pay for this. So you're going to get somebody to finance and protect your stock. So here we go. The first step is you own the pet company, and you're going to sell a put at 210. So you're going to sell a put that is higher than the price that you bought the stock. You bought it at 200, you're going to sell a put at 210, right? If the price keep on going up, you're going to lose the whole $300 that you got for that option, right? You're paying it. But you're protecting the $300 that you had to pay for this, at 310, is to protect you in case that the price go down, then this $300 start going up and you start making money. But right now, what we want to see that you have to buy the stock, and now you buy the option. We are not doing the color yet. Now here we go. Now what you do, remember, 200, you buy a put at 300, And now you turn around and sell a call over here for at the strike of 215. A 215 strike, which is your ceiling at 215, guess what happened? The call is higher than the put that you bought, because you bought this at 210 and this one going to be at 215. So now you sell a call at 215, and let's say that they give you $290. Okay, so now you're going to have a collar. This is step 2. Now we got the collar. So when you sell the call, right, you bought $300 for the option, the put. You bought the put here for $300. Okay, you already bought the stock at $200. You went and bought an option, a put at $210, and as the price go down, this thing start making money and going to cover the cost of this. However, look at this. You sold the call at the strike of 215, and they give you $280. Okay, so this is your floor price, 200. This is your ceiling price, 215. If the price of the stock is at 200, you got 300 for this when you bought it. Now when you sold this one, it helped you pay for this. So the only thing that this trick is gonna cost you is $20. That's nice, right? $20. So in case that you're getting confused, let me go over one more time. You're gonna do a color strategy. You buy the stock and it's 200, and you go ahead and buy a put in case that the price go down, and it costs you $300. Right here, $300. Now you turn around and you're gonna go a little bit higher than the put that you bought at 210, and you're gonna sell one at 315, and now you got a ceiling price. The guy that bought on step 2 the option, he give you $280. So now your total cost for the option is $20. Very neat, eh? So now the only operation is $20. So what happened here? If the price has to go up, right, you don't have to worry about it, because you're going to get $215 and they're going to call it. So you're going to make $500 minus the $20 that it cost you for the option. And that's it. Now let's look the other way. Let's say that the price start going down, right? You pay $300 for that. They give you $280 for this one. This thing gonna expire worthless because it's gonna be below $215. But the stocks go below that, and your option now for $20 is making money to make up the loss of the stock. So you're gonna be ahead of the game, because this option is gonna keep on up in value. You only got $20 invested on it, and it's making up any losses on the stock, or very close to it. So you got double insurance in here. The floor price is 200, the ceiling price 215. Anything that the price goes up above 215, you cannot get nothing. But you're going to keep the 280 to help you pay for that one. So it's going to cost you $5 up. If you go $5, you bought it at 200, so now it's at 215. So you made $10. You made $1,000 with 20, and only for a $20 protection for the insurance. And then of course you put going to expire worthless because the price went up. But on the other side, if the price go down, the $20 that you invested here is going to gain value, and it's going to offset the cost, the losses that you might have on the $200 stock on your floor price. In order to do this, you have to own the stock, and this is actually what happened here. So let's look at the complete result. How many things can happen in here? The option color setup. On the step 1, you bought a put. On step 2, you sold a call, and the difference was $20. Now, the net result of the initial option cost is $20. The 280 from 300, you got $20 in here. If the price goes up, your limited profits are to $1,500, right? Because you're going to go from 280 to 200, sell the call, 280 to 15, depending on how you do it. And what's going to happen here is that you get $280 for that call. It only costs you 20, and you're going to gain everything from here down this way. So this option going to go in premium, and it probably, as it go down, it's going to get $500 or more. If it stay on the same place, you're only going to lose $20. So if the price goes less than 215, right, plus above 220, so how much going to be here? More than minus 20. So whatever you gain going up, we don't know how much it is, but the only thing that is going to cost you is the $20 different from this. Now, you can have the other problems, right? The put, as it goes up, go to 0, so you got 215. So they're going to be $1,500 minus 20 on the put. So your profit. Now we take this one. How about if the price is what? Less than 210. The put is in the money, right? Because it's going to start coming down less than 210. It's going to start coming down. So the put is going to be in the money. So you're going to be making money. The price is less than 200. You call that you sold expire worthless, right? Because it was at 215. The put gain value, right? And the stock is less than 200. You're going to gain this part here. So depend on the volatility and how much the price go down, you limit profit to $1,500. If the price goes up, you're going to go to 200 to 215. You're going to get 100 shares. You make 1,500 minus 20. So that's when the price goes up. On the other one, it protects you coming down. So this is actually how it will work. So this is the final part of the color. You bought it, the stock, you bought a put for insurance, you sold a call, it only cost you $20 for protection, and if the price goes up, you're going to make $1,500 minus the $20 that you pay for the option, and the put gonna expire worthless, or vice versa. So with that, as we can see, we are done with the covered call. And there you have it. This is how you set up a color setup. You must own the stock. It's the only thing. You buy the stock, sell the option, you buy the put, sell a call, and you protect yourself. You can do these two things. You cannot do this on commodities. Commodities are future contracts, and you are actually don't own the commodity. So this is why we got an X in here. The commodity don't have, you have to own the commodity, and actually commodities normally are on future, and if you don't own it, you won't be able to do that. So this is what is limited to be done with the stocks and ETF, exchange fund. So I'm gonna appreciate your time for this lesson. You can review the lesson again until you understand how this done, from the simple call to the complex calls and put together, or for the simple put at the price go down for you to make money. So with that, let me thank you for your time, and I'll see you on the next lesson. So have a good day.
Hi everyone, and welcome to today's tip. Today I will quickly show you how to buy a long put option with a Fidelity account, and we'll explain some of the basic terminology associated with options. If you are unfamiliar with options, I encourage you to check out my options tutorial video as a starting point. But as a brief summary, options are a type of derivative contract, meaning they derive their value from some other underlying security and are most often used for speculation, increasing leverage, and reducing risk, or as hedges. There are a few steps you need to go through before buying an option. First, you will need to set up an account with a brokerage. Today's demonstration will use Fidelity. You will then need to fund your brokerage account with cash. The easiest way is to link your checking account and transfer cash directly from your checking account to your brokerage account. The final step is to apply for options trading approval. You can do this by logging into your account and selecting Options under the Investment Products dropdown. You will then follow the steps to get to the Margin and Options screen and then select Apply next to your account. My account might look slightly different as I already have approval, but once you click Apply, you will need to follow the steps and fill out the requested information. Approval usually takes a few days, and once received, you are ready to trade options. To begin trading options, you will need to log in and select Trade and then Options under the transaction type. You will see at the top here our cash currently available to trade with in our account, which is $415. Next, we enter the symbol. Today I will demonstrate a long put option on the SPY ETF. By entering into a long put on the SPY, we will have the right to buy the SPY once it reaches the strike price of our option contract. So essentially we are making a bet the price of the SPY will go down. The process for buying a long call option, which you would do if you wanted to make a bet on the price of the security going up, is very similar. After we enter in the symbol, we'll leave the strategy at calls and puts, since we are demonstrating a put today. And we can also see that the current price of the security is automatically populated, which is 274.03. Next, we are going to select our action. Buy to open just means we are buying a new option contract. Then we enter the quantity of contracts. Note that each contract is typically 100 shares. So if I buy one contract, I'm effectively buying options on 100 shares of the underlying security. Next, we enter the expiration date. If the underlying security does not reach the strike price by the expiration date, then our option will expire worthless. The farther out our expiration date, the more expensive the option is going to be. The final step is to enter the strike price. For a put option, the higher the strike price, the more expensive the option will be. Finally, we select call or put, and as I mentioned, I am buying a put today. Then we select our order type. Market orders will execute as quickly as possible at the best available price, and market orders are by far the most common. With a market order on Fidelity, the only timing option is day, which means the order will remain open for one full day and will be closed if not executed on that day. Remember, the market is open Monday through Friday from 9:30 a.m. to 4 p.m. Eastern, and you will not be able to place a trade outside of those hours. Once we've filled in all of the option details, we can click this max gain loss link, and we can see that in this case, our max gain is substantial, and the max amount we can lose is $0. However, bear in mind that does not factor in the price we are going to pay up front to purchase the option. Now we can preview our order, and we see that the estimated total value or cost to buy the option will be $352.65. So for a long put or call option, that is the maximum amount we can lose. It's important to note in this option we would have to make back the premium we were paying to buy the option in order to truly break even. So in this case, the price of SPY would have to reach $236.48 to truly break even, and I've shown the math behind that at the bottom of the screen. In a put option, the maximum amount we can gain depends on how much the price of the security goes down, and in a call option it would depend on how much the price of the security goes up. Then you simply review the order and place the trade. And note that if your option becomes in the money, you will need to execute the option or close out the option prior to the expiration date in order to avoid it expiring worthless. Lastly, I just wanted to quickly show you guys a few cool tools on Fidelity that you can use to evaluate options. So if you go to News and Research, Options, and then type in our security ticker, we get this grid that shows a bunch of different option prices, which are shown in the column on the left titled Last, as in last price. The price is shown per share, and remember each contract is typically for 100 shares. This grid shows calls on the left and puts on the right, and we can evaluate a bunch of different scenarios depending on the strike price and expiration date. Another cool tool is if you click the profit and loss calculator and play around with different scenarios in there. So I know this seems like a complicated process, but it's really not bad once you get the terminology down. Feel free to post any questions below. I'll do my best to answer them, and don't forget to subscribe for more tips. See you next time.